Welcome to InvestorHubX.com. Many beginners think trend lines are just lines drawn on a chart, but experienced traders know trend lines often become pressure points where explosive moves begin. In this video, we will explore: what is a trend line? What is a breakout? What is a breakdown? Real breakout versus fakeout. By the end of this lesson, you will have a much deeper understanding of how traders use trend lines to identify potential opportunities in the market. If you enjoy this video, don't forget to like the video and subscribe to the channel. It helps support the channel and allows us to continue producing more high-quality educational content. Now, let's get started. A trend line is a line drawn on a chart to connect important price points and show the overall direction of the market. In an uptrend, trend lines are usually drawn by connecting higher lows. In a downtrend, trend lines are drawn by connecting lower highs. Trend lines help traders visualize market momentum, identify areas of support and resistance, and understand the strength of a trend. When price continues respecting a trend line, it suggests buyers or sellers are still in control. However, when price breaks through a trend line, it can signal a possible shift in market sentiment and the beginning of a breakout or breakdown. Trend lines are not magical prediction tools. Instead, they are visual representations of market psychology, pressure, and momentum. So what is a breakout? This is Bitcoin on the daily time frame. The white line is a trend line. It connects the swing highs in a downtrend. When the price breaks above the trend line, it can signal a potential change in trend from a downtrend into an uptrend. This is called a breakout. A breakout occurs when price moves above a resistance level or breaks through an important trend line with strong momentum. In other words, it signals that buyers are gaining control of the market and pushing prices higher. So what is a breakdown? This is Bitcoin on the weekly time frame. The white line is a trend line. It connects the swing lows in an uptrend. When the price breaks below the trend line, it can signal a potential change in trend from an uptrend into a downtrend. This is called a breakdown. A breakdown occurs when price moves below a support level or breaks beneath an important trend line with strong momentum. In other words, it signals that sellers are gaining control of the market and pushing prices lower. So how do traders tell the difference between a real breakout and a fakeout? Not every breakout leads to a strong move higher. Sometimes, price briefly breaks above resistance, only to reverse sharply back down. This is known as a fakeout or a false breakout. A fakeout happens when the market creates the illusion of a breakout and traps traders into entering too early. Many beginners buy immediately when price breaks above a trend line. But experienced traders understand that confirmation is extremely important. So, what does a real breakout usually look like? First, price closes clearly above the resistance level or trend line. This suggests buyers may be gaining control of the market. Second, momentum continues after the breakout instead of immediately reversing. Strong continuation often indicates genuine buying pressure. And sometimes, price retests the breakout level before continuing higher. This is known as a breakout retest. In many cases, previous resistance turns into new support before the next move higher begins. Now let's compare that to a fakeout. In a fakeout, price may briefly move above the trend line, but quickly falls back below the breakout level. Volume is often weak, momentum fades quickly, and traders who entered too early become trapped. Fakeouts are common in financial markets because large players understand where many retail traders place their entries and stop losses. This is why patience and confirmation are extremely important in technical analysis. Instead of chasing every breakout, many experienced traders wait for strong candle closes, or a successful retest. Remember, a breakout is not confirmed simply because price breaks above a trend line. The market must prove that buyers are truly in control, and sometimes the best trade is the one you do not take. Understanding trading is only half of the battle. The other half is consistency. Many traders know technical analysis, but they keep making the same mistakes over and over again because they never track their trades. Professional traders do not simply enter a trade and forget about it. They record every trade, review their mistakes, and learn from their wins and losses. This is where a trading diary becomes extremely important. A trading diary helps you understand questions like, why did I take this trade? Did I follow my strategy? Was this actually a high-quality setup? What can I improve next time? That is why I create the InvestorHubX trading diary. Inside the diary, you'll find a trade quality scorecard where you can score every trade based on the factors we discussed in this video. You can record your entries, exits, emotions, mistakes, and trading decisions. Over time, patterns begin to appear. You may discover that your A+ setups perform much better than your C-grade setups. Instead of guessing, you begin trading based on data. Because the goal is not just to take more trades. The goal is to take better trades. If you'd like to learn more, check out the InvestorHubX trading diary below. If you find this helpful, please visit InvestorHubX.com for more lessons just like this. We are building a complete learning platform designed to help investors like you master technical analysis, stocks, cryptocurrency, commodities, precious metals, property investing, and more, step by step. You will also get access to custom indicators and in-depth video courses to support your learning journey and take your skills to the next level. In this lesson, we explored how traders use trend lines to identify potential breakouts, breakdowns, and fakeouts in the market. We learned that a real breakout often shows strong confirmation, momentum continuation, and sometimes a successful retest. We also discovered that not every breakout is real. Fakeouts can trap traders who enter too early without confirmation. This is why patience, confirmation, and risk management are extremely important in technical analysis. Remember, the market must prove who is truly in control. And sometimes, the best trade is the one you do not take. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.